Every successful trader, regardless of market or experience, has one thing in common: a structured trading plan. It's not the strategy that separates consistent winners from struggling traders, it's the plan behind it. A trading plan is more than a document or checklist. It's a complete framework that defines how you trade, when you trade, how much you risk, and how you make decisions. Without it, you're flying blind in one of the most competitive environments on Earth. In this video, iLines walk you step by step through how to build a winning trading plan that fits any market, whether it's stocks, forex, or crypto. By the end, you'll understand how to design a plan that aligns with your goals, your psychology, and your trading style. Let's begin with the foundation. A trading plan starts with clarity of purpose. Ask yourself, why are you trading? Are you doing this to create an extra income stream? To achieve financial independence? Or are you simply fascinated by market dynamics? Your why determines your time commitment, risk tolerance, and target returns. A trader looking for passive growth will build a very different plan from one who is day trading full-time. Once you define your purpose, move to goal setting. This is where most traders go wrong. Goals like make $1,000 a week are vague and unrealistic without a structure. Instead, focus on process-based goals, things you can control. Examples: I will follow my entry criteria on every trade, or I will journal all trades before the next session. Process-based goals build habits. Profit-based goals build frustration. Next, identify your market and time frame. Many traders fail simply because they trade in markets that don't fit their personality. If you like structure and lower volatility, stocks might suit you better. If you enjoy constant movement and 20/5 availability, forex works well. If you're aggressive and thrive on volatility, crypto might be ideal. Within your chosen market, define your time frame. Are you scalping, day trading, or swing trading? Each time frame demands a different mindset. Scalpers rely on precision and reaction speed. Swing traders rely on patience and trend structure. Your trading plan should specify not just the time frame, but the type of market condition you lines trade: trending, ranging, or volatile. Now we reach the core of your trading plan, your strategy. A strategy defines your entry, exit, and risk conditions. It's how you identify opportunity. Write it out in detail: what confirms a setup, what invalidates it, and how you manage trades. For example, you might say, I enter on a moving average crossover confirmed by our SI divergence, with stop loss below recent structure. Write it as if someone else could execute your trade for you using only the document. A strong trading plan doesn't just describe when to enter, it defines when not to trade. Avoid trading during high-impact news if your strategy isn't built for volatility. Avoid overtrading after losses or revenge trading after emotional swings. Once your strategy is defined, integrate risk management. Risk is where most traders lose before they even start. You should never risk more than a set percentage of your account on a single trade, typically between 0.5% and 2%. This ensures that even a series of losing trades doesn't destroy your capital. Define your position sizing formula, whether you calculate it manually or use tools. Know exactly how much to risk per trade. Also, decide how many open positions you'll hold simultaneously. Overexposure is a silent killer of accounts. Even if each trade risks 1%, 5 correlated positions can blow through 5% quickly if the market turns. Now comes a key part of professional trading: trade management. How will you manage open trades? Will you move your stop loss to break even after a certain point? Will you scale out partial profits? Will you use trailing stops or manual exits? These decisions should be made before you enter a trade. A plan prevents emotion from dictating your moves when money is on the line. Another vital component is record keeping and journaling. Every serious trader keeps a detailed record of each trade entry, exit, rationale, emotion, and result. A trading journal is not about blame, it's about data. Over time, it reveals patterns in your behavior and your edge. Use that data to evaluate performance. Review your results weekly or monthly. Focus not only on profit, but also on execution quality. Did you follow your plan? Did you respect risk limits? Professional traders grade themselves on consistency, not outcome. The next part of your trading plan should address psychology and discipline. Trading is 80% mindset. The market is designed to trigger your emotions: fear, greed, impatience, and ego. You must have rules in your plan for how you'll handle these emotions. For example, if you feel emotional after a big win or loss, your plan might state, take a 24-hour break before placing the next trade. Define your maximum trading hours per day and when you stop trading. Overtrading and fatigue are hidden enemies. Your plan should say, I stop trading after 3 executed setups or to consecutive losses. This keeps you consistent and mentally sharp. Now, let's tie it all together with example frameworks. Here's a simplified trading plan outline used by many professionals. Purpose: build consistent income through swing trading, forex, and crypto. Goal: execute 100% of trades following plan rules for 30 days. Market: major forex pairs plus BTC, USD, time frame, 4-hour and daily charts. Strategy: trend following using 5200ths EMA cross plus RSI confirmation. Risk per trade: 1%, max daily loss 3%. Trade management: scale out 50% at 1-to-1, move stop loss to break even. Journal: record every trade with screenshot and notes. Review: weekly review on Sunday. This clarity eliminates uncertainty. Every decision is predefined, reducing emotional reactions. Let's move to performance tracking. A professional trader doesn't measure success by profits alone. They measure consistency. How often did you follow your plan? What's your average risk per trade? Your largest drawdown? These numbers matter more than single wins. Your plan should include a section for tracking metrics like win rate, average reward to risk, maximum drawdown, monthly return rule, adherence percentage over time. These metrics tell you if your plan works. And remember, no trading plan guarantees success, but it guarantees consistency, and consistency is what leads to long-term success. So take the time this week to sit down and write yours. Make it specific, actionable, and measurable. If you found this guide valuable, give the video a like, subscribe to European Trader, and comment below what part of your trading plan you'll build first: your risk rules, your journaling process, or your strategy setup. And stay tuned, because in the next video, we'll dive into the psychology of trading, how to master your mind before you master the markets. Until then, trade smart, stay disciplined, and keep building your edge.